What is going on, everybody? David Ramsden Wood with Mark Rossano here, and we are here for another week's episode of the pregame show. We are going to do a quick travel around the world, starting with a small little tiger cub. Mark, how are you today?
Good, how are you? How's everything down south?
Down south is good. Arizona is good. The mask mandate came off, although life is totally exactly the same since all private businesses still require it. But I support it because businesses should be the ones making their decisions, not the government. So we teed off with a start on Bill Huang's, I don't even know what the capital firm was called.
Yeah, it was a small family. Small. It was a family office that
10 to 15 billion, kind of small.
Tiny. So it was about it was about 15 billion, and they were trading like it was about 85 billion if you consider about what type of derivatives were being used. And it's funny because I started my career doing total return swaps, interest rate swaps. And you don't realize when things go wrong, they go wrong in a big way. And these banks, or I should say prime brokers, are there just to make sure that they have the cash if you can't meet your collateral. And that was what we started to see with these huge block trades coming in, because he had a collateral call that he just couldn't meet. And that was when we saw this cascading failure and these gigantic block trades. And I think Nomura hit with a $2 billion loss. And it just gives you an idea of how quickly this can escalate if you're wrong way on some of these big positions.
So how much should we expect? Similar to when we saw GameStop, there was some potentially systemic risk in the system with some of these very quick calls and some small firms trading like big firms that maybe were at risk. We passed through that. How many more of these Tiger Cub-esque family offices with weird structures? I read the Ben Hunt Epsilon article today on why it's not a Tiger Cub, but it's a raccoon. And that they're basically creating synthetic products, selling stock that doesn't exist to avoid SEC discretion. This feels a lot like what was going on in 2000 and some of the Sarbanes-Oxley and Reg FD and all these things that got implemented. What's going to happen from this?
So the biggest issue is really what came about when you look at, as we went into 2008, where you had this liquidity that was coming into the front end of the curve. You had money markets that people were looking for cash preservation and not cash growth. And here's something where we're starting to get frothy. You're starting to get to a point where everybody wants long exposure, but they don't want to show the long exposure. So they do a total return swap, and you can do that total return swap in any index that you want. It could be the Russell, it could be the S&P, it could be the Qs. It's whatever your counterparty and you agree to. So there's a lot of optionality, but because it sits on a paper desk, you don't actually know what the exposure is, and you're not really sure. And you hope that the prime broker or the counterparty on the other side is sitting there and is managing that risk. But as we saw with Lehman, as we saw with Bear, and essentially just the financial crisis, when we start looking at the layers, we don't appreciate the leverage ratios, and this is where the leverage can get out of whack quickly. And the reason why that's the case, and not to go too much into this, but when you look at a Lehman Brothers, for an example, when you have guys, because let's say me and you, we're in the market, all of a sudden some of our positions start to go south. We don't like the way the market feels. Are you going to close your winners or your losers? You're going to close your winners, and then you're going to let your losers ride. Well, that all of a sudden creates a cash cushion or a cash crunch at the bank, because they're going to be sitting on their winners that contractually they can't close, but they're going to have to close out the ones in which they lost and pay out. And you start to see some of these shifts, and you can all of a sudden get a gigantic run on the banks. Now, this is something that is obviously they're sitting on a ton of liquidity. This is something that has been talked about in general, but the contagion that we've seen and the interconnected nature of these banks is becoming more and more prolific, where Turkey is becoming an issue for Spain. You look at what's happening in China with the PBOC offering to swap out what's called perpetual bonds, because banks are buying other banks' perpetual bonds and they're invested in the same projects. And they're like, okay, well, if something goes south, they're all going to get knocked down. So they're trying to take away some of that leverage because it could crash the system.
So what's pulling all this together? Because concurrent with that, we see that the 10-year U.S. Treasury is at the highs since January of 2020, really pre-pandemic. Well, what's driving maybe all of this liquidity crisis and yield and fear and risk off? And do you expect to see it, or is the Fed going to do something as they've done for the last year to really calm this market down?
I think right now they're gonna continue to let it ride, and the reason why they're gonna do that is because they keep talking about inflation. They keep talking about being okay with it being averaging over 2% for an extended period of time. The implied inflation rate is only 2.4, 2.5%, so well within the reason that they're talking about. And there's different ways we can look at the Treasury yields. You can look at it in the sense of, well, people are starting to get a little concerned and they want more money for their duration, or they want to be compensated for their duration risk, which is the inflation side. So they're demanding a higher rate. Then you have just a sheer volume. We're just asking the market to take down more and more debt. So as you start to exasperate essentially dwindle down all of your different buyers, they're going to say, look, if you want me to take extra, you're going to have to compensate me. And then on the bullish side, if you want to take the bullish front, it's that we have a reopening. So as you start to see an acceleration in activity, you're going to inherently start to see the velocity of money pick up. You're going to see some of those inflation, data start coming out, because you're going to start to see prices paid getting pushed down to prices received, and you should start to see some of this normalization in the economy in general. I have a more negative view on how that translates, but that's how you can look at it from both the bearish side and the bullish side.
Now, speaking of that, this morning the consumer confidence index came out and sort of blew things away relative to expectations. Any comments on that, or is this just more of the same as we move towards, stimulus checks have arrived? Biden has mentioned perhaps an incremental stimulus package in April, which is truly unbelievable. Tax rates have started to come into focus, which this isn't a surprise. And again, from a left-leaning populist government, you would think raising taxes is going to be high on the agenda for this year. What do you make of the consumer confidence and overlay with what's going on with vaccination rollouts and the reopening trade?
I think that you hit the nail on the head. I mean, that's what we're seeing. We started to get checks that are getting deposited into people's accounts. You're starting to see a vaccine rollout, like you talked about. Mask mandates are coming off. People are starting to feel better about where they sit in the world. When you look at where we are in hiring on the hospitality side, on the restaurant side, you're starting to see that hiring pick back up. So there's a lot of good things out there when you look at how is this being implemented and how are people projecting that. But then when you look at how they view their financial condition 12 months out, it's actually much lower. And when you look at the inflation expectations, that's starting to go up. So people typically are the most sensitive to, and they react on what they perceive inflation to be, not so much on what's happening at the grocery store, but what's happening at the price of the pump. And that is the one that we continue to talk about and look at when we're talking about gasoline and diesel prices, because that's where you start to see those inflation fears. Now, the reality of what we're going to see is, a lot of individuals have already spent the money, or the money's already been spoken for, whether it's on credit or back rent or paying down some debt. The issue is pricing, because when you think about a check that was delivered in April of 2021 versus April of 2020, your money is going to go in a vastly different length, just because we have seen those price increases, everything from food all the way down to the gas pump.
Speaking of the gas pump, we had a interesting dynamic going on in the Suez Canal over the last week where the Ever Given pulled an Austin Powers and got stuck between the walls. Some great memes on that. It got free, and you had predicted that we would see as many as 500 ships get stranded. How long will it take for those ships now that they're moving again to get through the canal and get back? I read that from an oil perspective, about 1.5 million barrels a day of world on-sea oil goes through the Suez Canal. Is this something really concerning for the oil markets, or does this just help the case of OPEC, who's meeting this week to talk about extending cuts?
It's just like anything else, it's transitory. And if you consider which way a lot of this crude was going, typically in a normal year, you have about 400,000 barrels a day coming west. And then you have about 1.2, 1.3 going east. And when you just look at the shifts in general, the Atlantic Basin was already so flooded with product that there wasn't really a huge issue. And if you think about what India, the fight that India had with Saudi Arabia in terms of buying, India has been picking up a lot of West African cargoes, and all of these cargoes really avoid those issues. So while it is a disruption, it is only about, let's call it 1% of the global oil market, and it cleared within, measured in days, not weeks. So in order to clear the backlog, it will move fairly quickly, especially because right when this started, we did get some ships that said, look, we're just going to go around the horn, not worry about it. We've also had some tankers that have changed direction. They were resold in different ways, and that's more on the clean side. So when you look at just what is happening in general, it didn't increase the demand for crude. Refiners aren't looking at this saying, okay, now I have to run more. It's just gonna screw up kind of the delivery of boats. So now it's gonna put more crude in transit, and then when two boats show up at the same time, because of the week or 10-day or 2-week lag, then you're just gonna have more floating storage before it can go onshore. So realistically, this was a transitory issue, but it does highlight how fragile these choke points are. And what needs to be watched when you're considering, what does this look like on a trade side. This is much bigger for cargo ships and container ships, because when you look at what is happening, we already struggled, and we're already continuing to struggle with supply chain disruptions, cost increases, and this is just going to make that worse as we continue to see some of this normalize.
Now, we'll close the conversation in terms of the OPEC meeting, but also American Airlines came out this week and said that ticket sales are now back to 90% of pre-pandemic levels. Whether you believe it or not, certainly for those who've been traveling, and myself as one of them, going through the airport, seeing the lines at TSA get a little bit longer. I think we're seeing some airplanes being pulled out of storage to accommodate demand. And yet OPEC is concerned about maybe world demand needs to be taken down from their previous projections. What do you think comes out of OPEC, and what are they seeing on world demand that perhaps we aren't?
So I think that they're going to extend. There's a good chance that we're going to start to see Saudi Arabia talk about extending their million barrel a day cut. Just because what we're seeing in the U.S. and the one thing that I've been talking about, especially on the jet side, we normally see an increase this time of year. It's spring break, it's Easter, so you normally you get that increase. The difference is a lot of this, when you look at pricing, first class prices are pretty much almost back to normal depending on the route that you're taking, where coach still is lagging, and there's going to be a utilization factor of how do we increase the utilization in order to maintain and profitability. But the problem is it costs a lot to keep these in storage, because you have to rotate them, you have to turn the engines on. You're talking about a difficult, expensive prospect. So if you can even carry that plane, you're going to try to bring it back. The bigger issue is international flights, European flights, and not so much China, but Southeast Asia and other Asian nations are continuing to struggle with just COVID cases, the rollout of the vaccine, and that is hindering a lot of these normalizations on a global scale. So I think we're going to continue to get closer to the 2019 level. We'll start to kind of flatline as we go into the spring months, which will be at a, let's call it a standard deviation below where we normally are. But then we're just going to go sideways just because we're not getting the international travel. We will continue to see some growth, but how many people are going to go from private because they can to first class? Are we going to start to see some of these planes try to add some first class seats or expand services on first class to try to incentivize and get some money back through the door? The other issue is it comes down to driving, and it's not just the U.S. driving, because U.S. driving, as we've been saying, was going to continue to get better as we go through a key driving period. But when you have Europe able to hit a record of gasoline exports and set a record of gasoline in storage, there is a problem out there. And now we're seeing the same thing happen in India. We're seeing additional pressures in other Asian nations. And then Latin America is seeing the same problem. So again, these are things that they're looking at because the U.S. is a small portion, and obviously small is relative, versus where the global crude market really sits.
Well, we are at a very interesting point as we enter into April and about day 375 since the original lockdowns. It's spring. We hope everyone has a wonderful spring break no matter what you chose to do. And until next time, for Mark Rossano, I am David Ramsden Wood, and we will see you later. Bye for now.
Bye. Talk to you soon.